Welcome to Business with Beers, a podcast for business owners who want to scale their business to massively grow their income and contribution by investing in people, process, and technology. I am your host, Brian Beers. This week, we've got a great show with Devin Elder. Devin is the founder of DJE Texas Management Group, a vertically integrated multifamily investment firm based in San Antonio. Since 2012, the firm has completed hundreds of successful investment projects, including several full-cycle multifamily deals. They currently own over 3,000 doors. Devin shares his journey about starting his real estate investment career with no money, getting a hard money loan to acquire his first duplex, and then along the way, he learned how to raise money and developed a solid track record. Devin talks about the benefits and risks of being a passive multifamily investor and some warning signs to look out for with other operators. If you enjoyed this episode, please share it, rate and review with your favorite part to help us reach more people. And if you'd like to learn more about topics covered in this podcast, please check out brianbeers.com and sign up for my free weekly newsletter delivering content directly to your inbox. Welcome to the show, Devin.
Thanks for having me. How's it going?
I'm doing great. Hey, so it wouldn't be Business with Beers if I didn't ask you. We're sitting at a bar in San Antonio right now. What are we drinking?
Okay, so my safe choice is Miller Lite, right? Like you can't get in too much trouble, I think, with Miller Lite, but that's not very fun, and that's kind of it's basically water. So I would go with the IPA. There's this beer called Axis IPA. It's got a big Axis deer on it. Cool deal. I think they make it in some small town in Texas. And I ran into that at a restaurant and loved it. So that's kind of my current favorite, Axis IPA. Good stuff.
Awesome. Great. Well, if you could share your story, who you are, what you do, and we'll go from there.
Yeah, awesome. So kind of today, just snapshot. I'm the principal of DJE Texas Management Group. We are real estate investment company. Basically, you can think of it as a private equity firm. We do mostly multifamily. So I'm a principal in over 3,000 doors of multifamily right now. About half of that we run ourselves. So we're vertically integrated, meaning we own the management company. Mm-hmm. We do the whole thing, right? We buy them, run them, and then we bring on a lot of investors for that. So we've grown that over the years. That's kind of the primary focus of the company. We also do some land investing. We do some redevelopment, some new construction. All that stuff's kind of peripheral. The real meat and potatoes for our company is buying big apartments in San Antonio, putting our team on them, and getting good returns for investors. Pretty simple business model, even though it's a pretty big company at this point compared to where we were a few years ago.
Yeah. So how is it, I guess, how's it grown? How'd you get started into real estate syndication? Why multifamily is your core asset? Maybe speak to that first.
Sure. Getting started, I bought a little rental house, and I actually, first thing I did was I paid some money, joined a coaching group just to figure out real estate investing in general. Didn't really have a lot of capital a bunch of years ago when I started. So I bought a rental house, hard money loan, 3 points and 12% interest, 14% interest. I don't know what it was. It was whatever was just a hair below extortion or the legal limit. I don't know what it is. But the point is, somebody told me early on, it's not the cost of capital, it's access to capital. Because if you don't have access to capital, you're done. So I kind of figured out how to get access to capital, even though it was pretty expensive. But I did that house. Bought this house, renovated, refied out darn near all the money. And that was a pretty cool magic trick. And so I started doing that over and over and over and I was working this day job, right? Worked for a big, $1 billion medical device company and was just completely had my mind set on getting out of the corporate world. Once I started doing real estate deals, I said, this is it. This is my ticket. It's going to take me a while to build it, but this is how I'm going to do it. Buy a house, refinance, fix it up, refinance out the money, get enough cash flow to cover my bills. That took me about 2 years to cover all, get cash flow to cover my bills. Then I let myself quit work. And that's when things really took off. And that was 2015.
Okay. So, when did you buy that first duplex?
2012.
Okay.
Yeah.
So it took about 3 years to then have your passive income cover all your living expenses, your personal expenses.
And the first year I did one deal and it was like learning curve. And look, I'm married. I have 3 kids. I got a lot of stuff going on and I'm trying to learn this new skill set and, keep up performance at my job. So that first year was like a lot of learning and one deal. But then the next year was 10 deals. And the third year was enough deals to quit my job. So it was like really exponential growth there. And then by the time I think when I quit my job at like 22 doors, something like that, then you run into the classic scalability issue. Like, oh man, this real estate stuff really works. I want to grow it. And it's like, well, you're going to you want to be one of those guys with 150 houses? I didn't. So then you start buying more doors at one address. Just makes things simpler. I had raised a bunch of private money from doing houses to where, mentally I could make the leap of, well, I've raised millions of dollars. It's just been one house at a time, Okay. If I looked at it, I've done dozens of deals, eventually hundreds of single family deals. I did that way too long, but I was like, okay, I've raised a bunch of capital. Let's try it all in one deal. Let's try to do $3 million in one deal. And once I kind of got over that confidence hurdle and delivered for investors on that, then it was like, all right, this game on, we can effectively buy anything now, right? If you make it attractive enough for investors and you employ the shocking business model of doing what you said you were going to do, then there's really an unlimited amount of capital that you can put in your deals. That's an oversimplification, but and of course there's plenty of work along the way, but that is true. And it was really a big aha for me because I started with no capital and I grew up without any, any role models of how to be wealthy, how to work with money. So my kind of poverty mentality growing up, I couldn't imagine that somebody had the problem of, what do I do with all this money? Turns out lots of people have this problem. What do I do with all this money? Right? Like I have a high W-2 and turns out a lot of them don't want to go learn this kind of brutal business of running an apartment complex. It's not very sexy, Yep. And so if they can own 70% of the deal and be totally passive and hands off, there's a lot of people in that boat. And I'm becoming one of them. I'm an LP in a bunch of deals myself, and I love it. I don't have to really do anything. So that once I kind of discovered that world and had just been kind of maniacal about putting investors first. And when you set up your companies that way, it effectively leads to unlimited capital.
Okay.
It just grows and snowballs.
A lot of great stuff there. I mean, some things to touch on. First, I think it's the self-belief, right? Believing in yourself that, you raised all this money and having that confidence that, you can continue to execute. I think that's a challenge a lot of people have is, they have the raw skills. What holds them back is themselves and their own like limiting beliefs that, 100%. I am capable of doing this and, I'm more educated, I'm experienced, and, just believing that you can do it is like 80% of that battle. So, I mean, it really is.
It's always man versus self, right? Like if you look at all the challenges an entrepreneur faces, it's man versus self, and that's it's you versus the economy and you versus this, and those things are all true, but a lot of it is getting out of your own way, getting over your own hurdles. I will say though, like if you're terrified of raising capital, you should be. But that is a huge responsibility. Yeah. And if you haven't done it, you should be terrified of losing other people's money. And so, I had to build that muscle up over a long time. That was just the way I did it. You shouldn't take that lightly. If somebody's taking that lightly, I don't want to invest with them. Right.
Yep. Sure. So, hey, let's talk about your team. It's a multifamily, it's a team sport. What does your in-house team look like? And then what is your, obviously you have third parties that all work together. Talk about that.
Yep. Yeah, absolutely. So you could think of I've got a bunch of companies, I've probably got 30 different companies out there for various things, but the core of it is the private equity company of which I'm the CEO today. We've got an investor relations manager and we've got an office manager who's also doing some kind of like junior asset management work, right? So 3 of us are employed in that entity.
Okay.
Then we've got a property management company, which is a separate entity. I have a president of that property management company, and there's probably 30 employees in that company, but only one reports to me. It's a beautiful thing. He's a total rock star. And instead of third-party property management, which we did for many years, we have a lot more control over everything by having it in-house. As we speak now, we are our only customer. We're looking at taking on one third-party client who's a buddy of mine, but you see these guys, they try to grow property management companies at 20,000 doors because you get a higher multiple on your valuation at that point, right? I have zero desire to do that. Again, this is 100% an investor first company. Everything else is built around that. I built the property management company so that we could better serve investors, and that's worked out great. So it's a property management company, a lot of employees there, have loved having that. And that's all a function of finding the right who. Dan Sullivan's got a book, Who, Not How. And that simple statement is so incredibly powerful. I was very fortunate to find the right who, and not figure out how to build the property management company, but find the guy that was a superstar for it. That's been amazing. So if you look at, private equity, pretty small overhead in terms of employees and things like that. Property management company, much bigger, but that gives us control. And then you go to kind of the outside tier, right? The people that aren't on my payroll. And that's, hundreds of investors obviously are a big part of this deal. We've talked to bigger private equity firms that could come in and provide most of the equity for deals. I never liked the trade-off. I never liked the power they would have over us. I set all this up so I would not be an employee, although I do draw a W-2 off one of our companies, but I don't want private equity shop dictating, calling shots and jamming us up right before closing, changing terms. So we just have a lot of investors. And if one investor for 100K says they're out of a deal at the last second, like it's completely inconsequential to us. And I like it that way. We can also serve a lot of people. These are just regular folks that have jobs or are retired, and we could directly send them money that is beneficial for them. I love that part of it. So investors, huge part of it. Then you've got kind of your professional services, right? Your legal. We've got a team of attorneys that we use depending on the project type. We've got countless brokers that we use depending on project type. I'm in a CEO advisory group that meets twice a month. And so we've got a board of directors for the company that I'm able to kind of, in a confidential environment, review stuff twice a month. I've got a personal executive coach that was a CEO of a big architecture firm here in San Antonio. We meet once a month. So there's kind of that advisory board that's critical. And then we've got some all the typical stuff, insurance, contractors, anything real estate related there. And then we've got some ancillary companies. We've got a consulting company, apartmenteducators.com, where we teach people to do what I do. And then we've got a real estate brokerage that runs all of our deals. So that represents me as my buyer broker, but also goes out and does deals for anybody, and our apartmenteducators.com clients and us and everything. So there's the brokerage there. So that's kind of it at a high level. Okay. Hopefully that's clear as mud.
That's great. Yeah, clear as mud. Good one. So talk about a little bit on the investor side. So why does someone want to invest passively versus going out and doing a deal themselves?
There's kind of this typical trajectory, right? I won't name anybody, but I've heard this story more than once. Smart person goes to school for 1 million years. They become a doctor. Boom. They start making a lot of money. They start looking at how much taxes they're paying. They go, all this time, I never considered how much taxes I was going to pay. And oh my gosh, how do I help? How do I get out of this? Oh, real estate. Go buy a rental house. A doctor makes all this money. They're going to run a rental house. They have an awful tenant, trashes the place. Oh, this is terrible. There's got to be a better way to be in real estate. I have capital. I have more money than time. And then they discover apartment syndications and go, oh, I could still get all the benefits, but I don't have to do anything. That sounds really good, but I'm really scared. Is this a scam? Does this work? And then they do one with a good operator and it works. And they go, I'm in. Let's do a bunch more. And so that's kind of the typical trajectory that we see a lot of times with passive investors. It's such a different animal doing what I do, which is like having 40 employees, having a brokerage, having a consulting company, running this stuff every day. Like that's a whole lot going on. That is not passive. And it's the complete opposite to just put 50K in somebody's deal, because you can be in 10 of those, you can be in 50 of those. And other than tracking down all your K1s for come tax time and making sure you're accounting for all your distributions coming in and whatever internal accounting you have, there's nothing to do. It's really a thing of beauty. So, that's what attracts people to it. I think they recognize that there's so much that goes into, let's say, buying a $10 million building, that they don't want to go build those skill sets, and they can own 70% of the deal, or, a fraction of that pro rata based on what they invested, and not do anything. It's really compelling. It's really compelling.
So what are the risks, right? When I look at doing, and I'm in a couple deals, the risk I see is, number one, the operator. Like, are you picking good deals? Are you underwriting them correctly? And then then it's the execution of the business model. So you put all this stuff that looks great on a spreadsheet, but can you actually deliver on those returns? So how do you, you said you're an LP in other deals. Maybe speak to that first of how do you look at it? And I would hope that, you probably mirror it for your investors as well.
Yeah, I look at it, I was talking to a friend of mine who you probably know too, but he said, I've been doing this as an LP for a number of years, and I've never seen a deck or pro forma that I didn't like. They all look great.
That's right. Yep.
Holy smokes. We start here and we end up at the moon. It's amazing, right? So it's too easy to make a spreadsheet do anything you want, and nobody's going to know, right? You can manipulate something and show something. And so the onus is 100% on the operator to whatever they're projecting to be able to hit that some way, somehow. So the risks are that the operator can't pull it off, that they were for a myriad reasons, that they were too aggressive on their growth projections, that something like COVID comes along and jams things up. There's like a million ways that
the renovations cost a lot more. They miss things.
That's right. Undercapitalization is like the problem pretty much of any business, right? Is getting it wrong. Or you have a sponsor that's like got every last nickel in their deal. And I see this, and this just infuriates me. It's like, I've been in some deals where the sponsor came back to me and was like, man, we need $50K to get through like this next thing. And it's like, you don't have that? You're running this multi-million-dollar deal and you can't float $50K out of your account, and just to make it easy for the investors? Like, what are you doing, man? You should not get out of this business. If you don't have the capital to take care of little things like that along the way, like, get out of here. So, it needs to be properly capitalized up front. My thing is, because if you go on Crowd Street right now, you're going to see a million deals, right? Yep. All over the country. They're all going to look amazing. And you don't know any of those guys. My thing and my philosophy as a passive investor is I got to know you. We have to be like almost buddies, right? And have played golf together, or something along those lines. Because I've had some deals that every time I like step outside of real estate and try something else, I've had a few just completely like 100% loss of capital disasters. Yeah. Right. And so when those things happen, I'm like, well, back to real estate. Like, it hasn't really failed me yet.
Yeah, it's like, keep it simple sometimes,
Keep it simple, man. Yeah. Yup. So I think as a passive investor, my approach is to build relationships.
Okay. Right? And then trust, and they have a track record, right?
Yeah, because you're totally betting on, you've heard the adage, you're betting on the jockey, not the horse. The horse is the deal. Like, oh, I kind of like this market. I like this deal. But there are going to be so many variables coming at that operator, and you've got to be a scrappy entrepreneur, problem solver, I think, to get around a lot of this stuff. And fortunately, I did so many small deals over so many years and got kicked in the teeth so many times with these small deals that I'm pretty scrappy, man. So when we see a problem on a bigger deal, a lot of times it's like, I've seen this one before. We know how to get around this. We know how to navigate that. And that's the thing I think that a lot of passive investors don't see, is just that day-to-day entrepreneurial scrappiness. Because it's not just buy a deal and wait for it to go up. In some cases it is, but I think in the multifamily market we're in today, you really gotta be a good operator to pull it off.
So, as an LP, and you can speak to as yourself or maybe some of your investors, what should they expect? Is it a cash on cash return? Is it an equity multiple? Like, what's a good deal versus what's one that maybe is too risky or too much? Like, it's probably not going to happen.
I call it a 15 to 20% average annualized return. If somebody's promoting a 20% average annualized return, to me, that feels like this is just my personal opinion, right? to me, that feels a little aggressive on a marketing deck. Now, if you deliver 20%, and I'm talking average annualized return, which is different than IRR. And I actually like to reference average annualized return because it's a simpler metric. IRR is a more complex metric.
Can you give an example of that? So if I invest $100,000,
if you had a 17% IRR, that probably looks like an 18.7 average annualized return. So average annualized return number is a little bit higher than IRR because IRR accounts for time value of money. And it's like this complicated formula that sometimes people's eyes gloss over. So I just say, hey, if you invest 100K with us and we do it for 5 years, and at the end of the 5 years, you've gotten your 100K back plus another 100K, 2x equity multiple, that's 20% per year, average annualized return. Everybody's like, I got it.
Okay.
So if I'm telling you it's a 17% average annualized return on 5 years, that's a 1.85 equity multiple. Turn 100K into 185. And that's pretty much what we've targeted on, many of our recent deals is just 17% average annualized return. And we always say a 5-year hold, even though we've historically sold inside of 5 years. But that's the number I'm looking for is average annualized return. Okay. So I would call it mid to high teens, 15 to 19%. If somebody's showing you 25% average annualized return, to me, that feels like, what did you miss, right? Like what are you being too aggressive on? And then we do a 7% preferred return, meaning, somebody's got 100K in the deal. We're sending them $7,000 a year. On a monthly base, over 12 months. So that's kind of I've trended simpler and simpler as each deal goes by. We just, hey, 7 and 17, 5-year hold. That's what we're looking for. If we can get out in 3 years and I can show you a 20% average annualized return, I'm going to call that a win.
Yeah.
Right.
Okay, good. Hey, so let's talk about you for a little bit. What are some of your daily habits that you can attribute to the success that you've created for the last number of years?
Yeah, it's different now than it used to be. I think, early on it was, I'll be 43 when this comes out, right? So that's kind of where I am in my life. Early on in life, it was so much reading books, right? Success books, that kind of stuff. And then it was joining mentorship groups. And the biggest difference in my life has been getting around the right people. Certainly knowledge is important. I think you can learn. I tell people, like our coaching clients in multifamily, like we'll tell you and show you everything. Yep. And you're going to get about halfway there. The other half comes from, you got to go do it, period. There's no other way around it. So I can show you half of it. And I literally will show you the whole thing and walk you through it and tell it to you 100 times. You still only get half of it. The other half comes from, you got to go do it. So getting around the right people, paying to be, not the smartest guy in the room. Like there's some weird thing that happens. We're social animals and it's monkey see, monkey do. And if you can read all the books you want, but when you get in the room with the guy that's he's a centimillionaire or even a decamillionaire and you can interface with those people, it just changes you. So that would be my number one piece of advice for anyone that wants to move ahead is find somebody that's doing that's where you want to be and get around them and copy them. And the best way to do that is just write the check, So joining mastermind groups, 100%, finding maybe local meetups, maybe other real estate investor meetups, if that's your thing. Yep. Right. I'm sure there's other small business, chamber of commerce people can get involved in. Totally. Like and pay for the shortcut, right? I mean, I'm a part of frankly, a bunch of groups, right? That I've paid for the shortcut and another thing about paying for it is now you're dealing with serious people, right? Meetups is like, sometimes it's just a disaster. So, that's been the biggest thing for me kind of in terms of habits, I've got a family, so spending time with my family, church, the exercise, diet, those kind of things really help me. But the biggest personal development for me has been running companies, period. Like today, what it looks like for me, my habit is run and grow these companies, because just by having to play at that level, you gotta stay on top of a lot of stuff. And that is like that's to me, it's the best game to play, and the best thing for personal development is running companies and being an entrepreneur.
Yep. It's asking the who, not how. I read that book as well. It is fantastic. And especially as you want to grow and scale, you got to look to leveraging other people around you and their assets and their skills, and not trying to figure it out yourself.
100%. Cause I mean, if you just step outside of yourself for a second and look at the whole situation objectively, we feel like heroes as entrepreneurs, and only I can do this one thing, but like, you're so limited on your time. It's such a finite resource, unfortunately. So you have to work through other people, which is this whole other skill set than the bootstrapping entrepreneur, get it up and running off the ground, which I did for many years. And I've had to make that difficult transition to working through other people in order to grow, because of just the inherent nature of the finite amount of time I have. Okay.
Yeah. Great. And where do you want to take your company? What is the big goal that you're working towards?
I like annual goals for our companies, because if you asked me 5 years ago where we'd be today, like I wouldn't have dreamed where we are. Mm-hmm. So I kind of take it a year at a time. Where we stand right now, kind of mid 2021, our target is 800 doors, new acquisitions. Mm-hmm. That's 20 million in equity. It's halfway through the year, and we're exactly halfway to our target. So we're on track there. I also have a land business where I have a profit goal for that business. We also have the brokerage. I have a profit goal for that business. We also have our consulting company. We have a profit goal for that business. So kind of goals for all those. And then, end of this year, we'll revisit, set goals for the next year. The longer term vision I have for all my companies is that they run in perpetuity without me, like I'm dead, and the companies keep running. And my foundation is the beneficiary of all that. So I took this model from a company called Syndication here in San Antonio. The guy that ran it passed away in the last couple of years, but it's a chain of movie theaters, right? The whole thing runs, and everybody in San Antonio knows what Syndication is. We're going to go to the movies. I don't know how they did during COVID. Obviously, that's the disaster for movie theaters, but let's assume they continue to run. This whole enterprise, and with a CEO and a whole staff, and they run all these movie theaters and everything. It all goes to nonprofit. And I think that is the coolest thing in the world. So I have hugely ambitious goals for my personal net worth and our companies and things like that. But really my longer term vision is that we set it up to run, basically a real estate company and ancillary companies that can run forever and benefit the foundation. That's like long term, like beyond my death, long term.
Yeah. What's your foundation's mission?
The mission of the foundation is basically to help kids that are jammed up. I don't have an eloquent mission for it. I started it about a year and a half ago. It's self-funded. So a bunch of my companies make monthly donations to the foundation, and the foundation makes grants to different things. So we've supported an orphanage in the Philippines that a friend of mine built. We've supported some stuff here in South Texas for orphan kids in South Texas. So it's all kind of based around like children's services. We've supported surgeries for kids with cleft palates, stuff like that.
Okay. Yeah, that's great. Any book recommendations that you're reading now that you'd recommend?
We talked about Who Not How. Dan Sullivan it's funny. I'm not in Strategic Coach, which is Dan Sullivan's company, but he is like my North Star of entrepreneurial thinkers. And he has influenced me so much just through his book. I've never met him and I'm not in his program, but I sing his praises every chance I get. So let me just say this, anything Dan Sullivan does, I think as an entrepreneur that you need to be paying attention to that.
Yeah, great. Yeah, I agree. So where can listeners connect and find out more about you and your company?
Best spot is our website, djetexas.com, Delta Juliet Echo Texas.com, where there's a lot of content. I host podcasts. There's all kind of stuff there.
Awesome. Cool. We'll link it all up in the show notes. I appreciate you coming on and sharing all your story. And I think it's been great.
Awesome. Brian, thank you, man. We'll have a beer here soon before too long, but I appreciate you having me on, man.
All right. Thanks. I'll see you.
All right. Take care.